The microphone's on and the webcam's on. Hi, everyone. Welcome to my private lending basics. I just want to go over with you guys tonight some of the basics of private lending, because if you come to my meetup, then you'll have a lot of the groundwork laid out so that you can just attend to exactly what the speaker is doing. So welcome. I saw two of you guys registered. If you're coming tonight, that's awesome. If you're watching it on the replay, just go ahead and watch it through, and you'll be ready to come to our meeting, which starts at 6:30 on Thursday night, the last Thursday of the month. So welcome, everyone. There's a little bit of a poll there that I have on the side. So I'm asking, do you have a 401k from a previous employer? Because if you do have one from a previous employer, it's very easy to transfer that into a self-directed account. In the things that we teach in our meeting, you don't need a self-directed account. You can use regular savings, but it's nice if you have a 401k that's been invested in mutual funds, and now you can invest it in some really cool real estate and earn a bigger return. So anyway, thank you very much for coming. That's the poll. You can just go ahead and answer your question there. And then what I'm going to do is I'm going to have a slideshow. And if you have questions, just put them in the chat, and I'll take breaks at certain times and just get to those questions. So let me just check right now and see. We don't have any questions right now. Just go ahead. You can type in your message and type in hi and your first name. That'll make it easier for me to call on you. If you want to speak to me instead of just typing it in, you can press the little hand signal like this, and then we could actually all hear your question. So let me just keep the poll up there for a few more minutes. So anyway, welcome to Private Lending Masters, and I'm going to go over the basics. I'm also going to give you a sheet. You can download it. So I'm going to show you that. It should be on the right of your screen, and you can click on the download button. It's a PDF, and you can bring that up and make notes on it as we go through. And I'm pointing to my other screen over here because I do have it open. So it talks about the potential sources for funding, as well as different types of documents that you need to secure yourself as a private lender. I'm just going to look over there. And then we're going to talk about the terms that you use to set up one of these loans. And actually tomorrow night, we're going to practice negotiating the terms with a buddy, that you are sitting next to in the meetup. So that'll be a lot of fun. So what I like to have you do is know a lot about the accounts and the terms. And then when you come to my meetup, you may be in contact with an experienced investor who may be rehabbing, have a lot of rentals. They may do land development. So I try to get speakers that are very active, very experienced, so that if you want to invest with them, you can then learn as you invest from them, instead of just paying for a course and then not knowing what to do after that. So it's nice to earn and learn at the same time. So if you get a chance, go ahead and download that sheet. You can print it out and take notes while I'm talking. We don't have to. You don't have to write on it right away, because I'm going to go through some slides. So let me go ahead and start the slideshow. I do have my green screen here. Unfortunately, Webinar Jam, which is the account that I use, doesn't really have a good way to put a cool background. But anyway, it's green, and green is the color of money. So I think we're good if we just keep it as green. So I'm going to start the slides at this point. So it's on there. Let me do the share with the introduction. So the club I founded a year ago was Private Lending Masters, and I had a real reason. I wanted people to have a much better understanding of how to use private lending in doing real estate deals. I had obtained a lot of loans back in 2005 and 6, and I also learned a lot about private lending. So I wanted to move more of my real estate investing into private lending, and I just want to share with people my experience with that, and having private lending be the major source of my funds and not bank loans. So I'm going to back out of that just so I can see. Yeah, I wanted to see my screen. So I hopefully SlideShare's on. Chat so I can see. All right. And thank you all for being here. Now we're going to just have this particular slide view because I couldn't get the actual slide presentation to work. So we're just going to go with this the way it is. All right. So that is why I started doing it. So just to give you a little bit of background, let's move to the next. I was laid off in 2003. I worked in the biotech industry. I had gone to school for a long time. I had a PhD in biology, worked in the biotech industry. And when I got laid off, it was just a certain point in my life where I had just moved into a new house. So I had a very big mortgage, and the mortgage was supported by 2 salaries. And I got laid off. I had 6-month-old twins. So I'd been off for 4 months, gone back to work for only 2 months, and my company did a big layoff. They actually tried to do it while I was on maternity leave, and my boss told them that was not legal. So then when they laid us off, the second layoff, they laid her off too, just because she defended me. So at that time, I had 3 rentals, and I'd been a landlord since 1989. I just don't believe in selling things. I had kept the first condo I ever bought when I bought a smaller house, and so I just kept it as a rental. So that's really how I got started. I spent the next couple of years learning as much as I could about real estate investing by starting with books, going to seminars, doing all the things that we all do to learn from. So it started out with this is the first condo I bought. On the left is the picture of how it looked the entire 20 years that I had it rented out, or 18 years, I guess. And then on the right is how we remodeled the kitchen with nice tile and new stove and new sink, and how we remodeled everything. We kept the cabinets really the way they were. We painted them though before I sold it. So when I started, I had this nice paid off mortgage on this Hawaii condo. I also owned a rental in New Jersey. And I'm going through these to kind of tell you how I leveraged the money to really get started in real estate. I had a 30-year mortgage on this, but I had bought both the Hawaii condo and this property at the right time, not because I was so smart. It's just the market timing. And as well as the third condo I'm going to show you that my husband had bought also at the right time in a low point in the market. His was bought in a foreclosure. This one, I know the guy had paid at least $30,000 more than I did when I bought it from him, so he lost equity. And on the Hawaii condo, same sort of thing. I think I bought it for at least $30,000 to $40,000 more than the people that I bought it from had paid for it. So I still had a mortgage on here. I was partway into a 30-year mortgage, but I'd refinanced to pull money out to use for real estate investing. And then the third one is a San Diego rental that I still own, and I refied that mortgage as well, and also later on took out a HELOC on that particular property. So I had a second on it as well. So that we did a lot on this one. We painted it. I actually painted the walls here when I was pregnant up on a ladder. I'm not that smart, but then we also did all the hardwood flooring. It made it super easy to move people in and out because it really had this gorgeous hardwood flooring. And we definitely paid someone to do that. It was not our own thing. The tile, this was the first tile floor I ever did. I took the 2-hour course at Home Depot. So really you can learn how to do tile by going to Home Depot and take that 2-hour course. And I put this here to let you know that if you ever do the tile in your house, you need to take the toilet out. You never put the tile around the toilet, because if you get a new toilet with a different footprint, it's not going to fit. So I found that out when I did rentals out of state, and they would call me and say, well, the toilet doesn't fit in that spot. And I'd say, well, why not? Well, we tiled around it. So that's the wrong way to do it. It should look like this when they're working on it. So my education consisted of reading books and going to lots of expensive seminars. By the end of the 3 years, from 2003 to 2006, I had owned 60 units. So I started with those three in 2003, and I'd gone to 60 units. Now, some of them were apartment buildings, but they were located on 17 different pieces of property. So a lot of single families and then quite a few apartment buildings. So during that time, I learned how to fund deals the alternative way. I had some owner financing, carry back the notes. The owners carried back the notes. And I started using some private lending at the time. So in order to be a private lender or work with one, I always give people this real estate investor matrix. And it really arose from the time when in 2010 and 11 and starting in 2009, I was coaching a lot of other people how to become real estate students. And they were pretty confused about where they should start because there's so many different things you can do within real estate investing that it's really hard for people to know, really what to do. So the 4 strengths that you have here, I'm putting a circle around it, are cash. They're in white. Cash, you can have credit, you can have time, and you can have skills. And the 4 types of investors are private lender, landlord, flipper, and wholesaler. And I've drawn arrows to make it clear which strengths you need to become which type of investor. So today we're going to focus on the private lender aspect of it, where you need some cash, you need some credit, you don't really need a lot of time, and you don't need a lot of skill. So it's cash and credit are the main things. With a landlord, to be a landlord, you need cash and credit, some skills, and not as much time. If you're flipping, you need more time, some skills, cash, and you don't need really the credit because it's based on whether you get a loan is based on the property, the value of the property. And the other easier entry point into real estate investing is to be a wholesaler, where you can use time and your skills to become a wholesaler. You don't really need the cash and credit because you're flipping the contract to someone else. All right, let me slide down here. All right. So it's really important to shift your mindset about money away from banks and institutions, institutional lending, and into peer-to-peer lending. So that's where you either become a private lender or you find private lenders to do your deals. And usually the first private lenders are family or friends that you already know. I took this picture when we were looking at a ton of REOs back in 2010 and 11. I used to take tours of 15 REOs on a Saturday so that everyone got a chance to get into a lot of houses, see, how they were laid out, what they were valued at least by the bank. So we did a bunch of tours like that. All right. So the good thing about private lending is you get to set your own terms. Now, what do I mean by that? If you've downloaded the spreadsheet where the asset checklist there, you're going to set your own terms. And I think that is, I'm going to take a look at the sheet here. Yeah, the part about setting your own terms is actually number 3 in your step-by-step plan on that 2-page PDF. And if you are joining us late or watching the replay, let me just show you where that is. Let's see. You can download that asset and accounts checklist right here. So go ahead and, I believe, yeah. So the file is, so I'm sorry, I apologize. I didn't click file sharing. I saw the download button, but this means that you can then go ahead and download that file. So I'll leave that on for a little bit. So you can set your own terms. What I mean by that is you can set the interest rate and how long the loan is, like how many months. Is it a standard 30 years, 360 months? Or is it 12 months? Is it 18 months? Is it 24 months? And you can determine if the person's going to pay you back monthly or if you're going to get paid back at the end if you're doing a flip, or quarterly because it's such a small amount, it's really not worth writing the check. So why have we not heard about private lending? We've definitely heard about, but why have we not heard about it in terms of our retirement accounts? Because Wall Street doesn't really want you to know. The code that talks about this is Title 26, U.S. Code 408. And it talks about how to use an IRA and what things you can invest in an IRA with. And it's really everything except collectibles, art, and things like that. So you can invest in real estate, gold, coins, all that stuff. Wall Street wants you to think it's only stocks and bonds and ETFs because they make a fee every time you buy it from them. And it's an easy transaction. They don't have to look at any documents. It's all automated. So I put in here an agreement to purchase form. And that's just to let you know that you could agree to purchase a piece of real estate with your self-directed IRA. So you do set your own terms. Oh, I'm sorry, I'm pushing on the screen instead of the actual PowerPoint. So how do you secure the loan that you have? Well, you secure it with a set of 4 documents. So if you lend to an investor like me, or you are the investor and a friend is lending to you, same thing applies. Here are the documents that you need to secure that loan to the property. So the first would be hazard insurance. So there's hazard insurance you get on the property. This is a vacant home. One of the flips I did in Poway, California, and it's a suburb of San Diego. And that's when, we'd finished all the drywall work. We still hadn't refaced the fireplace, and we were doing actually a little scope of work class in there, and that's why the table was there. So hazard insurance means that it's not the standard homeowner's insurance you have. It is insurance for a vacant home. And it's about 3 times as much as a regular homeowner's policy. So to insure something in the $200,000 to $300,000 range, you may be paying $1,200 for 6 months for that insurance policy. And it is because it's vacant. There's break-ins. A lot of its liability. Is someone going to get hurt when they're working, on your property? The next one is title insurance. So title insurance lets the lender and you know that you have title to this property and there's no other outstanding liens or taxes or IRS liens that haven't been paid off. So the title company ensures that you have clear title. And if for some reason you don't, the title insurance money you paid will take care of that, and title will clean up whatever mess that they created by not getting rid of all the liens before you purchased it. So the title insurance is paid for at the purchase. The hazard insurance, again, is paid for also when you purchase. You usually have to pay for 6 months in advance, even if you're only going to use 3. After that, they'll often let you pay month to month. Notes. So there'll always be a note with the terms, the interest rate, how many months it is, when you're going to pay them back, where you're going to pay them back, and the address and everyone's information. It's going to be signed by the borrower, and it's a note saying, you hand me money, I'm handing you a note, really an IOU, in exchange for the money that you handed me. Now, the note is the borrower, the lender holds onto the note because it shows that they lent money, but the mortgage or deed of trust, depending on the state that you live in, the mortgage or deed of trust secures, and that is notarized. It's recorded at the county, and it secures the note to the property. So the note is really just the terms. You keep it yourself in your file cabinet, and the mortgage or deed of trust is recorded and shows that a certain amount of money is owed on that property. So when the title does a search, they'll see that there is money owed. There's a loan on this property. There's a lien, and no one else can buy it. The owner, the rehabber, cannot sell the property without paying off the note, which is number C. So that the deed of trust is your security. So those are the 4 documents you really need to understand to do private lending. The other thing that I want people to understand is the HUD. It's now called something else. I don't even remember what it's called, but it's the same document. It's a recording of everything that happens when title changes. So it's how the private lender gets paid, their interest and principal at escrow. And the next slide blows it up a little bit. I'm just showing you an example of this one, and I hope switch to chat. No questions there. Okay, awesome. Okay, so in the HUD document, which you get when you close on the property, it'll show the borrower's name, the person that's purchasing the property, or the LLC. And I've got to look at a bigger version. I hope you guys can see this one. So here's the payoff. So in this case, $72,000 was borrowed from an IRA or from a private lender, and the principal balance was $72,000. And this one, I think, in the fine print, it was from October 2nd to March 16th. So in that time frame, for 4.5 months, interest was accumulated at 10% on the $72,000. And so the interest that the IRA received after the house was sold was $3,274.52. We also usually put in a wire fee. So in other words, instead of your IRA having to pay the wire fee, we'll charge the wire fee on the closing to make sure that the borrower is reimbursing us for the wire fee that we spent, because often there's an outgoing wire fee and an incoming wire fee on every transaction in your IRA. I mean, just like a normal bank would charge you as well. So the reason this one is interesting, and I wanted to share it with you, is in this case, we bought this house subject to the existing loan because the owner had passed away and the heirs just wanted us to fix it and then sell it. So since there was no one left whose credit would be hurt or damaged, the previous owner had passed away, and their credit, in their credit, they had a loan for $54,206. So we took over the payments and we mailed them in for those 4 to 5 months. And with the escrow, which was for insurance and taxes. And at the end, we paid off that balance of $54,000 along with a little bit of escrow because they had just paid the taxes, and some interest until the exact day of closing. A payoff fee to calculate the paperwork from the loan servicer, and a satisfaction cost to show that that loan had been paid off. So anyway, we bought it subject to, which was really nice because we did not have to get that $55,000. We only had to borrow $72,000, which helped us buy the house and do the rehab on this particular house. This house was up in Sacramento several years ago in the 2015, so it was fairly inexpensive when we bought it. So that's really how the private lender gets paid off after they do a note from their IRA. So the owner of the IRA never takes possession of the money. They don't take it out and send it to you. You give a direction to your IRA custodian. They send it directly to the escrow company that's handling this, in this case, North American Title. And then when North American Title when we sell the property, North American Title sends the money directly back to your IRA. So you never touch it. You just see an increase in your account. All right, let me just move on from there. So if you're going to become a private lender, what do you want to do? You want to look for experience in your team. You want to know that there's rehabbers there that have done a number of projects. You want to know that they're hiring the right contractors. And you would also like to review their previous projects. And this is really your due diligence as a private lender to make sure that your money is secured in a nice house. These are all houses that I used to own in Utah. Excuse me. So you really want to do due diligence. Make sure you get to know who the rehabber is, and quite a bit about their business. You can also invest with partners in JV agreements. So you want to find partners with experience, just like I had said before, and you can joint venture with them where instead of a fixed interest rate, you're getting a percentage of the profits. So what you need to be aware of there is that sometimes they make a nice profit on the house and sometimes they don't, based on the market fluctuations. So now you're taking a little more of a risk in order to get a higher return. So sometimes your return might be low and sometimes it might be higher because sometimes they're going to make a great profit that they're going to split with you, and other times it would be minimum. So I know we've made 50 to 100,000 on flips, and one time we made 9 and we split it. So that wasn't a fun time. That was just with just a partner, but the people who lent money were definitely paid off on that. That was just our profit. The other thing you can do is offer to bring a friend who wants to be a private lender to a deal and do a joint venture where you're bringing in some money, or maybe you don't have any, but your friend wants to do it, and you're checking out the rehabbers and investors with them, and they're putting some money into the deal. Then after they get comfortable with that deal, they may then invest in your deal next time. So say you don't have experience doing rehabs, but you know someone who does, you can have your private lender invest with the experienced team till they get comfortable with the process, and you've also increased your education. So now the two of you could go off and do a deal together on the next deal. Let's see what we're going to do here. Okay, so what do you need to do next? You need to learn about the accounts, and that's why I gave you the sheet to download. So you can go ahead and download that file. You can learn about the terms and the different kinds of projects that people have. So the accounts are listed in there, and I'll pull that up in a minute, and we'll go over that. Let me go to my next slide. And then once you get that kind of figured out, you're going to rinse and repeat. These are just people moving in and out of different properties. So you're just going to rinse and repeat and keep making money so that your IRA money will increase. So I'm going to take a brief pause here and see if you guys need to ask any questions while I pull up. I'm going to share a different sheet. I'm going to share that sheet that you actually were able to download, and we'll just go through a couple things on that, just so you understand all the different ways that you can source money. So turn share. Okay, so I have to change private lending masters assets. I have to change the file that I'm sharing. Here we go. So this is the sheet that you were able to download and hopefully print out. And so let's just go over some of the sources of funding that either you have or you have a friend who might want to invest with you as well. Traditional IRA. So you've had an IRA account that you opened, and you can then turn that into a self-directed IRA. So say it's at Vanguard, you can do a transfer. You open an account with a self-directed company, and then you have them transfer the money directly. You never have to take possession of the money. You can also do that with a Roth IRA. Now, a lot of people have less in their Roth than in their traditional, because traditionally 401ks, if you have a 401k, you didn't pay taxes on it, so you'd go into a traditional The Roth used to start with only about 2,000 as your minimum to put in, but you're putting in the Roth money after taxes. So any increases that you have, you're taking out and then paying on them when you take them out. So you can really grow that account. I mean, the most famous example, I think, is Mitt Romney. He did a lot of pretty fancy IRA investments with different levels of shares in LLCs and was able to really grow his Roth IRA. Health savings account. This is a new account that I'm exploring working with. It's the account you get if you have a high deductible insurance. In other words, your deductible for your insurance has to be 29 or 30,000. $2,900 or $3,000. I can't remember the exact number. It's around $3,000. And they give you a health savings account. Some employers put money in. I know ours does. But you're allowed to put in for a family. I believe it's now up to like $6,500. And you can Google what the limits are, $6,500 a year. And then you use the health savings account for premiums for insurance, for glasses, for dental work, and you can use it for prescriptions. So, and the good part about the health savings account is you can use it now. So you're not waiting till you retire. Whatever money you put in there, you're spending on your health care pre-tax. And the big thing is if you have a $3,000 deductible, you're going to pay full price to see the doctor and full price for prescriptions. I mean, until you hit the $3,000 deductible. So the health savings account is really important. And you also want to grow that so that, as you age and when you retire, you'll have, enough in there to pay for the expensive cost of prescription drugs. If you have an old 401k, you can roll that into a self-directed IRA, just like you can take a traditional and roll it into a self-directed account. A self-directed account is one that you can use to invest in real estate. Examples are UDirect IRA, Entrust, the Entrust Group out of San Francisco. UDirect is up in Tustin. And then Equity Trust is in Ohio. There's Pensco. There's Lincoln. There's a number of different self-directed accounts, self-directed companies where you can open your account. From your current 401k, if you still work with that employer, you can only take out a loan and then use the cash. And then it gets taken out of your paycheck to pay back the loan. A HELOC, you can take a home equity line of credit from the house you currently live in. One of my private lenders does that, and he pays like 3.5%, and then he's getting paid 10% on the money he lends out. So he's making 7% on the difference. So he's leveraging it. Savings accounts, everybody understands that. It's just whatever you have in your savings. And then friends and relatives who may want to go in on a deal with you, and they may say, well, I'll put some money in, and they have that in their savings or their IRA account. How do you become the bank? We went over the documents using a note and a mortgage or a deed of trust. And then the other thing you can invest in is tax liens. You can go right to the county. Now, not in California, because we do tax deeds where we sell the entire house when they haven't paid taxes. But in some states, I'll say, Illinois, Florida, Texas, you just put in the amount of money that the taxes are owed, and then that lien stays on the property until that person pays it back. And you're often getting interest rates of up to 18% on the taxes. If say you only paid like $3,000 for the person's taxes that they were behind on, when they do catch up, the county pays you back. And you can do that kind of investment with your self-directed IRA. All right. So what are the terms? You have to determine the interest rate that you want to be paid or that you want to charge as a real estate investor to your, that you want to pay to your private lender. So as a private lender, you're receiving. As the real estate investor, you're paying the interest. The frequency of the payments, monthly, quarterly, or at the end are the typical. And the frequency of the new investment. Do you want to keep your money moving, or would you rather put it in some rentals and have a lower income but not have to do a lot of paperwork? I'll give you an example. One of the guys who invested in one of our first flips said, he said, I'm on a motorcycle in Europe. I don't want to be doing documents and sending them back and forth. Just put it somewhere and give me the consistent income. So those are the terms. The investment types that you can invest in as a private lender. You can invest in someone doing a rehab. That's going to take anywhere from 4 months up to maybe 18 months if they do a very high end or they're building several units. A quick house flip could take as little as 4 to 5 months. And it's not so much the rehab could take, 6 to 8 weeks, but then they have to put it on the market and wait 30 days for a buyer. So you could put it into a rental, which is a longer term. And usually if it's a longer term, the interest rate is lower because it's steady. Development, you can put it into land development. Someone buys land, divides it into lots, applies for all the permits and the utilities with the city, and then sells the lots to a builder. And then I went over the tax liens. You can invest by purchasing the tax lien directly from a county. And a lot of this can be done online, without ever going there. You definitely want to make sure you know something about the house by having someone drive by and checking Google Earth. The pictures are often old, so you want to make sure that the house is still there before you pay the tax lien. Now, you do not have to put the whole thing in a self-directed account. You can split your old 401k and send some money to a real estate account and some money to, say, a stock account. So you can do that. It is not a distribution, so you don't pay any taxes on it. There are no penalties. So you choose the company that you want for self-directed. And in my meetups, I often give a list of some potential self-directed custodial companies that you can use. And then when you're coming to the meetings, you would want to vet the real estate investors by getting to know them, looking at what kind of projects they have, visiting the projects on site, seeing the numbers for some of their old projects that they sold, even looking up the documents there and seeing how much they made on those. So you would do due diligence on, and again, you're vetting them by looking at past projects and current projects, and then you're doing due diligence on the project that you select to work on to make sure that all the paperwork is in place for that. So anyway, that is what I have to show you and share with you tonight. I'm going to go back and over to the chat, see if anyone has any questions. Let's see if anyone answered the poll. So no one had. The first person who looked at the poll said they do not have a 401k. Maybe they're lucky enough to be with their same employer and never got laid off, like some of us have. Let me just check the chat. And you guys can feel free to type in a question if you have it. Otherwise, if you do come to my meeting, I'm there during the setup process. We do want people to come at 6:30 and network, have some food. We start the meeting at 7, but I am always there at 6 if you have some individual questions that you'd like to ask me about your particular account. So if no one's going to type any questions into the chat, I'm going to close out the webinar, and I would love to see you at one of my future meetings on Meetup. It's called Private Lending Masters, and I often post it on Eventbrite as well. And so I'd love to see you guys there. And thank you so much for listening to the presentation tonight. You all have a great evening, and if you're coming, I'll see you tomorrow.